This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Hey everybody, thanks for tuning in. I'm Mike Mansfield. Appreciate everybody watching our videos and listening to our content. Want to kind of dig into things today. Obviously, still a lot of headlines, a lot of chaos, a lot of emotions, a lot going on. But, my job function here sitting all day is to try to analyze data, look at information, and be rather informed and absolutely unemotional about what we think is going on. So there's a number of things that are interesting. I'm going to get into a lot of inflation opinion today, a lot of data, some thoughts on where I think the market is headed, the reality of things. Wanted to touch on a couple maybe little micro concerning points from an economic standpoint. We're probably living in something called a K-shaped economy. A K-shaped economy is where there's really the tale of two cities. Half of our society is absorbing inflation. They're doing well. They have money to spend. And then there's a lower tranche of our population that is tight on income and due to inflation in the last few years is really struggling to comfortably survive. And so that's very problematic on a high level, but from an unemotional economic standpoint, data is data. And the upper part of the K, you get about 63% of the spending coming from there, and that population is still spending. So we still have a lot of stability in GDP projections. We just wrapped up earnings, which I talked about in my last video. Earnings were the best they've been in 4 years. Net revenue of companies was very strong. Even with the war and all the chaos going on at the moment, there has been no erosion in earnings projections. Maybe that's a little concerning. Maybe analysts will certainly catch up with that, but at the moment, it's yet to be seen. And so if earnings do hold up, that is very powerful and very helpful to the economy. And as I always touch on in the beginning of the year when I'm giving price targets for the S&P, what do we look at? We look at earnings, we look at the deregulation trade. We talked about tax returns rolling back in as economic stability. We talked about the Federal Reserve changing in May. There's a lot of general tailwinds that are still favorable to the overall market. Some of those micro concerns that are certainly curiosity, a little bit eye-raising. One thing, for example, auto loans, 90-day delinquencies. So people who are behind on their auto payments are at 5.2%. That's the highest since like the late 90s. So a little concerning, but you also wonder, we'll say the microcosm of that. During COVID, when the auto supply fell, car prices shot up dramatically, one due to inflation, but the other thing is the supply side, you had markups on vehicles where people were paying $5,000, $10,000, $15,000, $20,000 above MSRP. And now that that's dissipated, a lot of people are sitting upside down on vehicles. And so is it a component of, it's very expensive and overpriced? Is it a component of people don't want to pay for a car that was, we'll say, poorly valued when they purchased it? So that's its own little thing shaping up. The other component to that too is credit card debt. 90-day delinquencies are up to 12.7%. That's the highest level since 2011. So we've got a couple little localities of spending cash flow concerns that we're watching. Obviously, that's its own construct of inflation, wage growth, all of that kind of stuff, comfort level. But what I want to dig into is let's talk about inflation. So what creates inflation? Inflation, how come my chart's not there? There it is. Inflation is simple. It is money supply and money demand. When those two things, as one of the best economists, Milton Friedman, said, when supply exceeds demand, inflation is created. And so that's what happened in 2021 is a lot of money was added to the supply. And because we weren't allowed to spend it, the economy shut down via COVID, the demand changed. And when that was out of whack, it led to hyperinflation. And so what we see here is the M2 money supply. So this is the very most obvious liquid money market checking savings accounts in the economy. And you see since the 90s, we have this really stable 6% trend line. And then COVID hits, the money supply jumps up 40%, creates this massive gap in the trend line to the current money supply. And it's been normalizing, but there's still about $1.3 trillion of a gap to get it back to complete normal. But even to that point, the demand changed. And when all that supply was there, it was pretty obvious that inflation was right around the corner. Now, what's interesting about the money supply, or excuse me, this growth trend of 6%, it's actually normalized dramatically. So here we can see M2 growth. And what you see is during COVID, the growth just skyrocketed, right? And then it's collapsed and it's kind of normalized. And over the last 6 months, the money supply annualized growth rate is at 5.3%. And over the last 12 months, that money supply growth rate is only 4.9%, which is actually historically low all of a sudden. Now we're coming out of a very abnormal place. Hopefully, if this money growth and supply stays really stable, we'll kind of catch up with that regular trend line. So this is a really net positive as we think about the outlook of inflation at the moment. This chart sucks. I apologize, but it's the best I got. So this is money demand. Now, money demand is a little harder to wrap our heads around. So the chart that we use to figure out money demand is we look at the M2 money supply as a relationship of nominal GDP. And same thing, COVID, what do we see here? We see the demand for money skyrocket, right? And then it's now coming down and it's normalizing. And it looks like the money demand is finally back to where it was pre-COVID, which at the moment would be considered normal. So we have a normalizing money supply. We have a normalizing money demand. All of these things bode well for the high-level concept of inflation. So that is a net positive. Remember, inflation, obviously there's a lot of debate, a lot of arguments, things are expensive. But this tells a very interesting story. Here's the price trends of inflation since the 90s. And it's kind of fascinating when you zoom out to see like the bottom line, the durable goods. Net since the 90s, durable goods are down 30%. There is no inflation in totality in durable goods. In fact, with COVID, obviously changing supply chains and creating chaos here on the right side of this chart, durable goods since mid-2022 only grew at a totality of 2%. That's like a 0.6% annualized growth rate on durable goods. Whereas you go to like the top line, right? All of the inflation drama that we've had has really been associated with services, but a subset of services is shelter costs and wages. And so shelter costs are a massive lagging indicator because if rents go up, but people lock in a 1, 2, 3 year mortgage, obviously, if rents start to come down, we don't see that in the inflation data for a long time until those contracts come due and things all get repriced. But in totality, when you look at some of this stuff, it is fascinating that, yes, let me look at this. The core personal consumption deflator in the last year is up 3%, obviously above the Fed's target of 2%. The overall personal consumption deflator is up 2.7%. CPI as of February is up 2.4%. And if you took out shelter from the CPI, year over year, the consumer price index is only up 2.2%. So mathematically, we're trending mildly above, obviously, the Fed's targets. Now, I take it a step further. Obviously, the current event that we're very curious about is what is the Fed's going to do? I'm having a hard time, we'll say, with the strong opinion of current events. Here I am on the CME price watch tool, tracks federal interest rates. So here's the April meeting. So obviously in April, no plan for a rate cut. June, 92% chance no rate cut. July, 88% chance no rate cut. So obviously the probability declines. But remember, the Federal Reserve chair is about to change. When that changes, everything changes. Back on here. There we go. I'm going to turn off my phone too. Everything changes. And so when we look at all of this in totality, I'm not hugely concerned, ironically, about inflation this year because once again, money supply is normalizing. The demand for money is normalizing. Now let's take that thought a step further. We're concerned about the current events. Oil prices are going up. Obviously, that can be a natural indicator that inflation is around the corner, and that might create a temporary price phenomenon. But remember, oil prices are just one piece of the puzzle. Even right now, we're seeing non-energy commodities coming down in prices because everything's a trade-off. If people drive less, maybe they go out to eat less. Maybe they do something else less. Maybe they don't go to an airport. Maybe they don't go to a hotel. And so we have trade-offs between what is GDP growth, where are people spending money. If the demand for a service is suddenly declined because oil prices are high, that can offset inflation in totality. The other piece of the puzzle is interest rates have come up due to the drama with the war risk and all the current events. And that all of a sudden will now soften demand on the general housing market, which will then soften out inflation there. So there's a lot of pluses and minuses that it really is a hard path to see inflation come up dramatically at the moment. Ironically, if the war persists, if oil goes to 200, there's going to be a lot of other things probably breaking in the system before the crisis of inflation being very high. But those are the things that we're watching. At the moment, the stock market is starting to feel like it's gotten to some kind of bottom. The VIX is spiked. The hedge fund shorting is at its peak. The fear greed index is basically at the low point as it was during Liberation Day. And you start looking at multiples and where people's attitudes are. And right now, even the Mag 7, the big boys, they're at the best prices they've been in a really long time. Everything feels really attractive in that sense. This to me is an opportunity to purchase some equities and be patient. I'm an advocate that if earnings hold up as they currently are and the projections are, is that the market will probably very likely be higher much later this year. So in any case, there's my 2 cents for the week. If anybody has any questions, thoughts, concerns, curiosities, please don't hesitate to reach out. Give us a call. Visit our main website, thelindgroup.com, and we'll talk to you guys soon. Have a great day.